Hi, welcome to today's Daily Maverick webinar sponsored by Orbvest. My name is Ruan Jooste. I'm the business associate editor from Business Maverick. And today we're trading places, we're talking in different spaces. And we're going to talk about property plays all around the world. My two esteemed guests that's joining us today is Chris Immelman. He's the MD of Pam Golding International, and the beautiful Nonhlanhla Mayisela, who's joining us. She is the CEO of Izandla Property. Welcome.
Thank you.
Thanks very much, Ruan.
Just as a start, just so our guests can get to know you a little bit better, Chris, let's start with you. Pam Golding is known for selling beautiful high luxury properties in the hills of Clifton, but everybody's not that well aware of what the international arm does and how long it's been there and what the prospects are. Maybe you can give us a bit of context.
Yeah, thank you, Ruan. I'd like to do that. As some people may know, that the business was started by Mrs. Pam Golding herself many, many years ago. In fact, in 1976, the business started as Pam Golding Properties. And the business was essentially a business aimed at selling high-end properties from one South African to the other. And sort of that's how the business started, that's how the business grew. And that's certainly the mainstay of the business. However, in the late 1990s, and in fact, early 2000s, Andrew Golding asked me, I was then doing some other stuff in my previous career, and he said to me, well, what about an international business? There was an international business going, but it was very sort of London-centric. And so I really took over the business in 2000, and then we started growing the business from there. In the early days, we were very London-centric. So our go-to place was selling London apartments to South Africans. It was great business at the time because London prices were fairly low, and of course the exchange rate was reasonable at the time. However, as things progressed in sort of 2002, 2003, when London properties suddenly started shooting up and going north, at the same time our currency started going south, and that spread became very difficult. We started looking elsewhere for good opportunities, and that's where the real growth of the business started. We always had our eye on Mauritius as a leisure opportunity for South Africans, wanting something a little bit more exotic, a little bit different. And in 2002, the Mauritian government decided to open up their property, as it were, to foreigners. We were at the forefront of that. In fact, we helped put some of the legislation together with the Mauritian government at the time. It was called IRS schemes, and we were right at the very beginning selling leisure property to South Africans. What we did see there, Ruan, was quite interesting. Whilst people were interested in the leisure property itself, but because you bought a leisure property for 500,000 USD, you were also entitled to Mauritian residency, and that proved to be actually the bigger pull than actually the villa or the leisure property itself, or Mauritius itself, was the fact that you could gain alternative residency. So we started out to look.
Let me stop you there. We're going to get into that part now. I just want our viewers to just kind of be introduced to Noni. Noni, maybe you can just, you are a lady of the land, a proud South African, more locally focused. Maybe you can tell us about your venture Izandla Property and your path of where you come from and where you go.
Sure. Thanks, Ruan, for the opportunity. So just a bit of background in terms of my history or journey within the South African property sector. I joined the sector at a very young age, and I think the timing of it was opportune because I think that was at a time in our country where real estate as an asset class was starting to become very attractive, and obviously at a macroeconomic level, certain things were working in favor of property. And we saw the growth of these listed real estate funds over a decade. You saw significant growth in property in South Africa, equally in the unlisted space with property developments, etc. So I came into the sector when property was really becoming a real attractive investment and gaining significant momentum, certainly from the listed end, attracting institutional investors as well as private investors, where historically, I think certainly from where I come from, while property is something that resonates with everyone, it was not really familiar from an investment perspective. Fast forward, I guess 17 years later, and I was extensively involved in commercial and industrial property development for a long time. And it's really a close-knit sector. So, having spent that much time in the industry, you get to understand what the different dynamics are that drive growth in the sector, and who the key players are, both in the unlisted and listed space. So who is Izandla Property, and how do I feature there? So Izandla's focus really is building a homegrown, Black-owned, women-owned and managed real estate fund that operates in the unlisted segment of property within the South African borders initially. We've had a 3-year stint, so still fairly new. And really, we endeavor to visibly support the principles of transformation along the full property value chain. Our investment strategy is targeted towards quality assets underpinned by quality long-dated leases, primarily in the commercial and industrial sectors. We'll speak about the subsectors that exist in property a bit later, and where we really seek to deliver value to stakeholders, equally our investors, through sustained income and capital growth over time. A very interesting time to be a small, what I would call a small fund, in a very volatile environment, an uncertain environment, but certainly very exciting. I think in summary, our journey started in late 2017, and in the first quarter of 2018, we did our first significant transaction, which was an acquisition of a diversified portfolio, again, spread between retail, commercial, and industrial assets, to the value of about 520 odd million. And that was an acquisition of assets from Invested Property Fund, who's also a shareholder in Izandla. First quarter of 2018, again, we did a smaller transaction, just under 100 million rand. The second quarter of 2019 saw us really reinforcing what our strategy is, which is what our investment strategy is, which I've mentioned. And that was the conclusion of our first development to the value of 200 odd million, which was underpinned by a 15-year lease with Sasol. And that's the space that we seek to operate in. Now, we have a conversation around local property investment versus global, but certainly Izandla is a homegrown SA Inc. business, and certainly our outlook in terms of South Africa is positive, has to be positive, and I think there's real value and opportunity to continue looking at South African real estate as a feasible investment alongside other considerations. So,
well, it's very clear that your value proposition is literally and figuratively worlds apart. So let's get back to you, Chris. You have beautiful islands of Mauritius, the prospect of Malta, beautiful beaches of Portugal that you are punching to your client. Maybe you can just give us, our listeners or our viewers, just a bit of a background about how this proposition of buying residential bricks and mortar property offshore, and let's just kind of leave the other perks of residency out of it. Why has there been such an appetite from South Africans in that specific sector of the real estate market?
Twofold. So if we look at the islands, Mauritius and Seychelles, it's definitely a leisure play. I mean, Seychelles is just the most beautiful place in the entire world. Proximity to South Africa is good. The direct flight straight onto the island from South Africa, and the value is still good. If you look at the value of a high-end villa in the Seychelles versus the value of a high-end villa in the Caribbean or in Europe, on the coastline of Europe, it's still a lot better value. So there's an appeal for that. So it was strictly a leisure play. So leaving aside as you say, the residency and citizenship, there's a leisure play to it. Mauritius, the same thing. So Mauritius is close, it's familiar, it's easy to get to, and it was relatively inexpensive in the early days. So that's the sort of play there. The London play is just to diversify your assets. So the guy's not looking to say, or the lady's not looking to say, well, I'm going to take all my assets out of the country. You say, well, I need to diversify something. I'm heavily weighted in South Africa. I need to take some money out, and I need to guard myself against where the currency is going to. So there's, those things are important right now. It's the sovereign risk, the political risk, and the currency risk. So people need to hedge themselves. So our clients, we don't deal with many clients that say, well, I'm going to take everything out, or I'm really going to leave the shores of South Africa. They just say they want to diversify. They want options. They want to create a fallback position for themselves. And sort of that's where it is. And that's what the interest is. Certainly initially, before it became a little bit more residency and citizenship centric, beg your pardon. And I can go into that a little bit later. But as an asset class, it does make some sense. The UK also was fulfilled the need for many South Africans which wanted a place to go and stay there when they go on business, or maybe their kids go to on a Rhodes scholarship, or they get a scholarship to one of the other big universities in the UK, and they want a place to stay, or their kids go and work for Investec in London and they need a flat, that kind of thing. So we help fulfill that need as well. But I think overwhelmingly people want to diversify the asset class. I mean, just that's a strategy, I think.
Well, we're speaking of diversity earlier this morning, Noni, when we had a chat where Chris is coming from, the kind of residential offshore property market. You are more in the commercial, industrial type of space, but not just in South Africa. You have a bit of an African scope as well.
Yes, so I think primarily, Ruan, in the initial stages of Izandla, and certainly my background in property has primarily been in the South African, or within the South African borders. I think we've seen a lot of activity, outside of our borders, primarily in sub-Saharan Africa, but equally a lot of volatility in that space. So if I bring it back to SA for a second. I think, like in any region, I think the two fundamentals that drive South African real estate, certainly, or growth in that sector, is political and economic stability. And I think Chris has touched on it in terms of what investors are looking for from a certainty perspective and risk appetite. And we've obviously seen what the picture looks like from certainly politically in South Africa. I think the instability, not necessarily something that's unique to SA, but I mean, there's a history in terms of where we come from in the last 10 years. And I think there is certainly effort in trying to get things right. And anyone considering real estate investment, primarily if you're looking for investment in direct property, you want that certainty from a political perspective. If you look at, sub-Saharan Africa, you've had political instability, but in saying that, feasible transactions have been done, and investors have taken up investment in the rest of Africa. Economically, I think we understand where we are. I've got this COVID-19 crisis that we've got to deal with. The property sector itself has been significantly impacted in terms of what's happened. Certainly in the last 12 months. It has underperformed for a long time. Actually, even before COVID-19, the sector has experienced muted growth and underperformed, I guess, relative to other asset classes like bonds, your equities, your cash. But in saying that, I think my backstop when it comes to what the outlook is in terms of property investment is it's a long-term game. So the short-term cycles that one experiences, whether it's a growth cycle or it's the other way around. If you're in it for the long haul, you are set to see some form of value. Again, just in terms of outlook with the different sectors, I think the listed sector has experienced significant devaluations, trading at significant discounts. Therein lies the opportunity, I guess, for any first-time investors in that listed space to come in at this time where they can pick up really deep at discounted rates with yields that are tracking close to 20%. Really good counters. From a sector perspective, I mean, there's been sectors that have really been hit by the COVID-19 crisis, the office sector being one of them. And I think the outlook in terms of any investment going forward in the office sector, one has to exercise caution. There was a that was building in that sector. The industrial sector has held up very well, and I think that goes for any industrial exposure in Central Eastern Europe, UK to a certain extent. Those markets have really performed well in terms of industrial, obviously driven by some of the distribution demand that has taken place as a result of online retail, etc. The retail sector, again, we've seen quite a significant knock in South Africa in terms of retail, and I think you'll see muted growth in the retail sector. There's still quite a bit of recovery that needs to come from there. Sector for funds.
Let's for a second. We'll get back to you. We have a lot of reader questions here, and I don't want to leave them behind. They are so eager to chat with our panelists. Chris, Lola Berry asks the question, why would you go to the hassle of buying a property offshore and all the paperwork and everything if it's just much easier to do a different offshore investment, like in bonds or in a real estate a REIT offshore?
Yeah, you're absolutely right. It is a lot more tricky and it's a lot more illiquid, as we know. It's a little bit more challenging. I think the people that we deal with, typically they are invested in those sectors in the first place probably already. Another one would be they like the romance of owning an apartment in London. It sounds quite nice. It sort of feels, sort of as one sort of judges your own career as it goes, well, okay, got that one, got the apartment in London kind of thing. So well done to myself kind of thing. So people do tend to want to go through that. The one thing that I do think some people, there are many people, and I see it, from experience that we've sold to, that they don't understand the rest of the world. They don't understand what a REIT's about. They don't understand what it is to invest in a fund in the UK or Europe or in America or wherever it is, or Africa. They don't really understand it that well. I'm not institutional investors. I'm talking about individual investors, but they do understand owning an apartment in Putney. They get it. They understand how it works. They understand what it's about. And then once we do sit down with them, it is actually quite easy. It's not a lot more difficult than saying, well, let me buy an investment apartment in somewhere in Johannesburg, in Melrose Arch, or in Mully Point in Cape Town. It's not terribly different, because the first world is set up really well. There's a managing agent in place. There's a mortgage broker in place. We help you with the solicitors, and from there on, it is what works for you. So, I get it that it is a little bit more difficult and so on, but people do like the feeling of touch, feel. I can go look at it one day. There's my apartment. I get it. It's easy to understand. A little bit more difficult to transact, I admit, and of course, transactional cost, of course, added to that as well.
Noni, we got Robert Ulrich here that's asked, what is the difference in value proposition of a local REIT to an offshore REIT like just mentioned? And what is the 2 to 5 year prospect of these two cross-border listed property stocks?
So, Ruan, I think for me, anyone considering getting some form of access to real estate stock offshore should probably start with looking at local counters. So I think the benefit that we have with a lot of our large REITs is that they've got some exposure to offshore real estate, which is, I think, a fantastic way to diversify your portfolio from a risk perspective. So for me, if you've got comfort, obviously, with the underlying management that is managing the local counters that have increased the exposure to offshore real estate quite significantly in the last 5 years. What makes sense for me, and I guess the man in the street that wants to start investing in property, is put your money in those type of local counters, and you probably have about 40% exposure to offshore real estate. You obviously have to do your homework, and I think that's what's attractive in terms of a diversified portfolio. There are obviously offshore platforms that you can look at, which I don't have much experience on, but I certainly know that one opportunity is investing in existing listed funds that have significant exposure. You've got to do your homework, I think, in understanding those markets and what drives those markets. I think there has been a bit of pain that has been taken in some of the offshore markets where some of the REITs have gone into. And again, some of it is cyclical, so it's really sticking in. So if you have flavor for a bit of SA and a bit of offshore, there's a lot of options available in the current listed market where you get exposure to both, and you don't have to worry about the underlying management of the assets and the value that's created, because you're obviously backing the management team. So for me, that's an easier way in terms of entry for the broader community in South Africa, if you wanna call it that.
Well, Chris, I'm going to throw 3 international countries in your face that our readers are interested: Israel, Turkey, Portugal. Go.
I'll start with the easy ones first. Israel and Turkey. Israel, we've had a look at. It's expensive, and its a barrier to entry is quite difficult. It's difficult to get in there and to get to know the local developers and what's better than the other. So we've taken a cautious approach here and just stepped back a little bit. Turkey, we've done some work on. We've been approached by the developers and the people that are handling the Turkish residency program. So certainly we are looking at it. Why we favor Portugal is because it's linked to Europe. Turkey is not part of the EU. It doesn't look like it's going to be part of the EU in the foreseeable future. And the end game here for most people is to get a springboard into the EU. Portugal is almost one of the founding members of the EU. It's a country that is known to South Africans. It has other benefits as well. It's cheaper by the rest of European standards. It's the weather is incredible. English is widely spoken. Very, very safe country. I think it's number 3 on the Global Peace Index. So it's been an easier fit for us. I mean, we've done over 380 South African families just to Portugal. And everybody sits down. When they sit down, they have a look at everything. So why don't I buy a flat in London? Why don't we do Cyprus? Why don't we do Malta? Why don't we do Spain? Why don't we do Turkey? And we look at all of them. And then, depending on your own, what works for you as a family and as a unit and what your aspirations are, we then select. And it more often than not comes back to Portugal. So the other countries, we keep on looking at new stuff. Montenegro is on our radar at the moment. It does have a good residency program and citizenship program. We might do it in future, but I haven't finished my due diligence there. I'm a little worried about the sovereign risk there and what happens there. I need to establish that I'm okay with it. Greece, we're far down the road. We're almost close to doing Greece. But again, I'm a little bit worried where the risk is there. So until I can go and do my DD on site, walk the walk, meet the people in situ, we're reluctant to offer something that we haven't done. So, but Greece will probably be the next one that we'll offer.
So this is kind of a double whammy question for you both from one of our readers. The first thing is, in this diversified portfolio, is there a limit of how much offshore property you can own as a South African, for you, Chris, and for you, Noni? Also, kind of in a portfolio, what kind of is the saturation point of a South African exposure into property in a diversified portfolio in the current market circumstances? Let's start with you, Noni.
So I think for me, I mean, if you look at any form of, I suppose you're saying concentration risk here, and I think with the existing volatility in SA, which is going to be with us for a while, so whatever economic and political risk is going to be with us. So I would suggest that anyone that is looking to get exposure to property or has significant exposure, let's say beyond 70%, that's probably quite significant. You want to reduce that. And like I said, I think, an easy entry is if you're putting your money in a stock that has 40% exposure abroad and you have 60% exposure to SA, that probably is a good balance. I think from a performance perspective, South Africa will see muted growth. There are some funds which are concentrated in terms of specific sectors like self-storage, industrial, that will hold value, and you'll see growth in those particular sectors. I think you've got to be careful with a lot of these diversified funds that have kind of significant exposure in office and retail. You're going to see muted growth there. So I would consider reducing exposure if the spread in terms of the sectors of the funds is quite diversified, because you're not sure where you're going to land up. And I think equally offshore, there are some sectors that are better performing than others. Sectors that have really gained momentum offshore is your specific sectors like hospital, cell phone towers, for instance, which is something that's a bit foreign in SA for now. and residential sectors have performed well. I've mentioned the industrial sector. So for me, a balanced portfolio, I suppose, balanced exposure is probably a 60-40. I'm always bullish about SA because the outlook is permanent. And if you are too, it is a patience game. You're definitely going to see better returns offshore. But balanced, I'd say 50-50 or 60-40 weighted towards SA is probably the right answer for the next 2 to 3 years.
Yeah, I think the question to me was, is there how much offshore property can you own, and is there a limit to? No, not at all. As long as you are within the boundaries of the South African Reserve Bank in terms of money that you declare that you take out every year, there's a certain amount. I think it's 10 million rand that you take out per person. So you and your spouse can take out 20 million rand. Add to that your discretionary allowance of 1 million each. You can take out 22 million each year. So if you have been taking that out for a while and you put that into some offshore bank account and then you decide to transact from there, there's no limit. There's no limit as to how much you can earn. You're entitled to earn whatever you can earn, providing you don't transgress any of the laws in the countries that you're buying in, and of course the countries that you live in this case South Africa. So there's no limit there.
Chris, you mentioned exchange controls. We're one of the few countries in the world still left with kind of capital controls. But in the budget speech earlier this year, the Finance Minister, Tito Mboweni, did announce a kind of rehaul of the system, making it a bit easier. Does any of those changes apply to what you do and for your clients who want to buy bricks and mortar offshore?
No, not really. We don't really get involved in that side of it. Typically, as an example, a client would come and see us and say, well, I'd like to do this, this, and this. And they say, well, do you have money offshore already? If they don't have money offshore already, we have a few currency partners that we work with, none of them exclusively, but we work with a few currency partners. And then we'll refer you to a currency specialist that'll help, you with that process. And, it's a fairly simple process. Most people will use their own tax advisors to get a tax directive or tax clearance from the Reserve Bank. Typically, that could take as little as 5 days. It could take as long as 2 weeks. But typically, sort of 10 days, 12 days is what you can work on, providing your tax affairs are in order and up to date. So your tax returns must have been remitted and returned and all in order. If all of that's in order, you should get tax clearance within 7 to 10 days. So it's fairly easy to do that. But as long as it's fully declared and you're fully up to date with your taxes, there's really no issue there.
Noni, we've got a couple of questions here regarding, speaking of taxes, capital gains tax, other taxes that you get on your distribution from your rental income from an ETF. It's pretty easy to understand. People get taxed on their rental income from bricks and mortar. How is the income that you generate from listed property differently treated from a tax perspective?
So I think the one benefit in investing in real estate investment trusts is that there is no, from a fund perspective, the guys don't have income tax, so they have a REIT dispensation where they get tax efficiency. So in terms of the fund, you've got your P&L. There's no tax that is charged to the fund. So you get your distribution and you get charged dividend tax, like any other investment. Obviously, if you are, selling your shares, there is CGT implications again, like any other asset class, in that instance. So you do have, I think that the one benefit is that the REITs have some form of tax dispensation. Where your net distribution is not taxed, but it is taxed in the investor's hands. So you would have to pay dividend tax like in the ordinary course of investing.
Chris, the question comes back at you. There's been a couple of questions about capital gains tax, estate duty concerns of people who own property offshore on the one side. And of course, people are shouting more countries at me that you need to go. Italy and France are the next two.
Italy and France, no, we don't do any business in Italy and France other than we go there every now and again to eat some pasta or drink some good wine. But real bricks and mortar business, we don't do in Italy and France. We understand that Italy is looking at a program and it's a magnificent country, aspirational place and so on. It's very, very difficult doing business in both those countries. From a transactional point of view, from a legal point of view, from a title deed point of view. So we've been a little bit cautious there, but if something good does present itself, we'll have a look at it. But at the moment, I don't want to spread ourselves too thin and sort of focus at the moment as to where we think we can add some value.
And then we come back to the kind of capital gains tax and estate duty question. Yeah. People who live here but own property offshore.
Yeah, so you've got to be very careful as to where you buy and how you buy, as to the tax consequences. I'll mention two of them. So in the UK, for example, if you earn less than, I think it is £12,500 per annum net rental. So that is after deduction of any expenses and costs and so on. You fall below the tax threshold and you won't pay any taxes. So it is very advantageous if you are under that threshold, because you pay no taxes. Incidentally, while we're speaking of taxes, the British government has also recently announced to stimulate the property market post-COVID that they've given investors a tax holiday on stamp duties, and that's a significant saving, because that's an 8% that you normally pay on stamp duty. You pay 0 or sometimes 3%. It depends on where it is. But for any property under, I think it's under £500,000, you pay 0 stamp duty. Now that's a very big saving. That comes to the end of the 31st of March. So that's interesting to note. If you look at something like Portugal, you will be taxed on your rental income. Doesn't matter. So there's no threshold there like there is in the UK. Whatever your rental income, your net rental income, it is 28%. There's some tax deductions that you can make there, some interest deductions, and of course your body corporate fees, levies, etc., etc., etc. But you do pay 28%. Both of those countries, we have double taxation agreements. So of course you have to declare it in South Africa, but you will get a tax credit. There are no inheritance taxes at all in Portugal. They have very strict inheritance laws, in that most of your assets have to go to your nearest and dearest, so your spouse and your children, etc., etc. And there's no inheritance taxes paid on there. But you have to, of course, balance that with your South African estate, and that will form part of your South African estate, even though you have a will there, whether that's in Mauritius or whether that's in the UK or whether that's in Portugal. We urge people to make sure their affairs are all in order. We're careful, Ruan, to get too involved in the technical tax aspect of the business, because that's not what that's not where our expertise lies. We've got to be a little careful. So anecdotally and superficially and at a high level, I'm able to give you my experience where it is and sort of know what I'm talking about. But I can't. I'm not an expert there. So first thing we'll say is make sure you get some good advice in that regard. But there are some Mauritius, incidentally, again, there's also no inheritance tax there, no capital gains tax in Mauritius either. Capital gains tax in Portugal is 28%, and income tax is 28%.
While Chris has taken us to exotic places, it doesn't mean that the listed retail sector is not without interesting prospects and innovative ideas. It's not just about factories and shopping malls. We spoke this morning about very interesting developments, like in storage facilities being quite an interesting property prospect, or even cell phone towers that are being built where people can buy underlying shares in. Maybe you could just tell us about some interesting innovations in the property space. Your microphone is off.
My apologies.
There we go.
Okay, so I think, besides your traditional sectors like industrial, office, retail, you've seen quite significant growth in the self-storage market. One particular REIT that has done significantly well over the last, 5 to 10 years, that is focused on self-storage, which historically wasn't really a focus in terms of property investment. And suddenly, where you formalize that type of sector and you list a platform, it is really attractive to investors. And I think the need or requirement for self-storage will continue to increase, particularly in a market where I think most South Africans are considering downsizing just because of where the economic outlook is and affordability. And we've seen a significant increase in in your low to middle income type of residential developments, but people store goods and they need these facilities. And I think this particular REIT has leveraged quite well in terms of that demand. Healthcare is also a sector that has received quite significant focus with 1 or 2 healthcare funds that have been established in the past. And I mean, if you look at what's happened in the last kind of 10 months with the COVID-19 crisis, anyone that has exposure to the healthcare sector in terms of underlying real estate has really seen significant returns. And I think if you think of the fundamentals in this particular sector, especially with your much bigger healthcare groups, if you have solid covenants from your likes of your Netcares or your Life Healthcare, etc., where you've got this real estate that is really permanent in its nature and significant equipment that sits in the real estate. So the risk of these tenants being the operators moving out is highly unlikely. So therein lies your sustainability in terms of your income and capital growth. You mentioned cell phone towers, and again, in South Africa, anything that is not formalized and something like that is an opportunity to formalize that type of platform in terms of cell phone towers. And we've seen significant growth in other regions like the US and Europe in terms of this particular subsector, but not too much take up in SA. And it is really an opportunity. Again, there's permanency in that. You always need connectivity and you always need this type of infrastructure. And why not make a return out of it? So that's an opportunity. There isn't a formalized fund, I don't think, in SA that is particularly focused on cell phone towers, but it certainly is an opportunity. I think your traditional sectors will continue to perform but see muted growth. So if there's an opportunity to invest in your sector-focused segments like self-storage, healthcare, and if you can get offshore exposure to your cell phone tower funds, etc., that probably should be where the growth is coming from in the next kind of 2 to 5 years, I would say.
Chris, another question here from our viewers. They say, do you have any kind of comparative stats about residential house price growth here compared to certain countries abroad where prices have been kind of growing very kind of at a faster rate or a better rate, or look very attractive at the moment?
Yeah, we do. So obviously in South Africa, we've got all those stats available through our group, so we know what's happened. Yeah, and then of course in the countries that we work in, certainly the countries that we work in, more than others, like the UK, we have very, very good stats available. Portugal, we have great stats available. Mauritius, we have great stats available. So those are really, really good. But to come to some numbers on that, I think one has to take a view on South Africa in this regard. South Africa's house price increases have been driven by inflation. I mean, that's really where it's come from. So you'll see it now without inflation. The developers in the old day, they used to build something, an off-plan, announce the prices, then 3 years later, the prices were like 15% more. That was really because of inflation. It was not really anything else. The rest of the world didn't have inflation where we operate, and it didn't have that kind of inflation. They've got inflation, but not that kind. So the growth has been muted. But if you look at some of the areas where you see growth are regeneration areas. Areas that are previously has been left behind for whatever reason. You can pick out the cities. Berlin is one of them. We dabbled in Berlin a little bit, did some work in Berlin. Berlin was going through a complete slump. Nothing was happening in Germany. Yet, aspirationally, it was the place every young student, when they graduated, wanted to move to in Germany. So you graduated from university in Bonn or in Frankfurt or in Munich. You wanted to go and work in Berlin. Why? Because it was cool. So that became a city where all the young people wanted to move to. All the clubs were there, great outdoor life, cycle around, etc., etc. Very cool, hip place to be. And suddenly developers thought, and they started regenerating the place. So the old bomb sites were carefully sort of, taken apart and regenerated. That's where your value is, and that's where you see prices will start increasing more than other places. So they had a run of 7-8% year-on-year increases because there was a story behind it. Exactly the same has happened in Lisbon. 4.5 years ago, Lisbon was a derelict city. Believe me, I was there. I saw it. I said, guys, what is going on? And until they started this program where they could offer international investors residency to their country, they realized that the only way they can do it is by fixing their city. And I'm not going to bore you with all the detail now, but the European Troika, the European banks came in and said, we'll help you out if you do this, this, and this, and this. One of them, incidentally, was to abolish the Rent Control Act, which was the significant unlock for the city. So that went through regeneration. And when you saw regeneration, you see prices off a low base climbing very, very quickly because they need to play catch up with their other peers. So if you look at the prices where Lisbon was compared to Madrid and Barcelona, their closest big, European neighbors, they were way below because it was a crumbling city. And so suddenly they put the right things in place and the city lifted like this. So nowadays you'll see the things will come. It even happened in London. I mean, London wasn't a fantastic city in the late 90s. It only became a fantastic city in the early 2000s when all these new developments started happening because they introduced laws to make it favorable. And sort of a lot of the old, you see a lot of those buildings are old power stations that are being rejigged now into fancy, modern, hip-looking apartments. That's what drove the prices. But now, in a stable market, when you get to UK now, you don't see it. You don't see much growth in the market. There was no growth in prime central London for the last 5 years. It means zero. Now it looks like there's a little bit of growth back, but in the commuter towns, there is growth now because there's demand for commuter towns because too expensive to live in prime central London. Move to a commuter town. I can still commute to work in half an hour, 35 minutes, but the price of my apartment is half, if not even less than that, what I would pay in London. Now that opportunity, you will see growth of 3-4%. In South Africa, I still think in the right areas, you're going to see some growth. Don't know if it'll get back to you could take poison. You knew your house was next year is going to be worth more than it was this year. That's just the way it went. But then suddenly it started stopping. I know exactly where I live here. So everything, I know what I paid for this property 10 years ago. It's worth a lot more than it today. But it was the same price last year and the year before. So in the last few years, it's been, slowing down quite a lot. So we played sort of catch up and our inflation has come down. So you won't see that huge disparity between house price growth in South Africa versus the rest of the world. They sort of come in sort of similar places. And that brings me to yields, so you'll see the yields the same. Yields in let's say London was for sure 5, 6, 7% you could get, so it's in Lisbon. Nowadays, 3%, because capital values have gone up. People haven't got enough money, so they can't pay more rentals. So your rentals didn't stagnate, but they haven't gone up as quickly as the capital values have gone up. And so those two have caught up. So you'll see yields, real yields in Lisbon today, 3% in the UK. Maybe in places like Birmingham, great example, another regeneration city that you'll still see 5% returns. But those are rental yields.
Noni, my colleague Ray Machacha has asked, do you think local REITs or listed property will recover quicker after the COVID crisis, as most of them have kind of suspended their distribution payments? Do you think it will come back to school? And as Chris mentioned, what are the yield prospects for some of these funds locally?
So, Ruan, I think the reality is the recovery is going to be slow. And I think we need to maybe go back a couple of years, even before COVID-19. I think for the last 5 years, you've probably seen property stocks come off quite significantly. And, there was significant growth in the last quarter, 10 to 15 years. And what happened during that growth cycle is most of these REITs were securing tenants and acquiring assets that were underpinned by, long-dated leases that were escalating by 8-9%. With no reversions, and valuations, property valuations were increasing over time, and it was really just a straight line for a long period of time. And obviously the underlying pressure there is, you've got a long-term asset, but you need to deliver short-term returns to your investors. And I think that's where most of these funds have been caught. So you get to, let's say, 2018, even before COVID-19 came through, you then started seeing a bit of a disconnect in terms of some of these underlying valuations with the listed funds. So the underlying valuations of actual assets versus where these funds are trading, a significant gap started in terms of the market cap that investors were applying versus the underlying valuations of the assets. The leases were coming to an end, so suddenly where most of these funds had to renegotiate leases, they had to take significant reversions because rentals have been growing for a 10-year period, escalating at 8%, which is fine in a growth cycle, and you're obviously able to deliver returns to investors. But property fundamentals have been skewed for a long period of time. So we come into COVID-19 with those fundamentals not being in place. The sector was completely annihilated. I think we've seen negative growth of probably about 25% or more in the last 12 months, and similar numbers, I think, last year. The reality is what's happened, or the focus of these REITs in this time, was trying to protect top line, so your revenue, while tenants were falling over all over the place. A lot of the REITs haven't paid distribution, primarily because they've had to give significant rental concessions to their tenants just to retain tenants and not increase vacancies. So again, on the back of an economy that is not growing, you're not going to see meaningful growth in the sector for a long period of time. In saying that, I think if the outlook for anyone that's looking at the local real estate investment, if your outlook is 5 to 10 years, you probably start seeing the wheels turning in another 3 years. But I would say, one stays put for a while. It's going to take a long time for these REITs to recover. Property fundamentals have to come back. So there needs to be devaluation of some of these assets, and that happens over a period of time. You can't take a knock once off. Rentals will be flat. Escalations, you either have no escalations or really limited escalations in most of the sectors. And that's just the outlook. Again, if you are invested to take your money out now, I'm not sure, because you're gonna experience a significant knock. If you're a first-time investor coming in now, where these funds are trading at significant discounts, then you're probably in a better position. But you have to stick it out, I'd say, for the next 5 years. And like I said, at a macroeconomic level, our economy really has to start turning for anyone invested in property to see real growth. And that goes for listed and direct property investment. And to Chris's point, I think, around residential, I just want to touch on that. There's obviously subsectors in terms of residential, and I think Chris is right in terms of growth, I suppose, in terms of high-end residential. So anything, I would say, beyond 3 million upwards will see no growth. That's just my view. But I think there's a dynamic in SA that there probably is an opportunity from a residential perspective. The low to middle income residential sector, I think, has been more resilient than any other subsector in residential, and will continue to do so. And that's driven by demand, because we've got such significant demand in terms of housing in the country. You continue to see a lot of developments coming in that particular area. So one has to consider, if you are looking to invest in direct property, particularly in residential, maybe the low to middle income sectors where you should be looking. I think interest rates are favorable if you're able to secure your debt at kind of 8%, which is 100 bips above what current prime is. And I think we're going to experience a low interest rate environment for at least the next 24 months. There's an opportunity there. And if your property is yielding, let's say 10%, you're accretive from day one. Obviously, you got to factor in all the other costs that come into it. So yeah, I think from a residential perspective, just to Chris's point, there are subsectors in that sector that still are worth looking at from an investment perspective.
Well, just a fair them both, you pack, both your hats. One of our viewers, Nico de Kok, says, you three, well, including me, I don't know why, Noni, Chris and Ray are property fundamental giants. Well done. Back to you, Chris. Someone has asked here, is there opportunity in some of the SADC countries like Mozambique or Namibia to kind of divest into residential brick and mortar property? And is that something that you are looking at?
No. The only country that we are looking at is from a SADC point of view, are Mauritius and Seychelles, and we've touched on that. We've done a lot of work there. It's been a great journey for us, and we still offer lots of opportunity in both of those countries. But our immediate neighbours, as a group, as Pam Golding Group, we're represented in all the SADC countries. We've got a very large office in Kenya as well. We looked at Nigeria at one stage and so on. But no, so we don't have any. You feel where your client base wants to go, and the client base that I'm involved in and I look after on my side of the business, they're not saying to me, "Can I buy a house in a Rari?" I'm not suggesting there's not an opportunity for somebody that's really bold and brave to go and buy something in a Rari, because it will change. It will eventually turn. But for our clients, I don't see it. Certainly not now. And so we haven't got any immediate plans to be doing that. As I say, we got Offer Pam Golding as officers in Nori. I know all the people there. I talk to them frequently. Other way around, I get business from them in that they got businessmen there that may say to me, "Chris, this guy, he's interested in buying a flat in Chelsea, or can you help him?" kind of thing. But our Kenya office has done different stuff. They've done a lot of stuff locally, and but we've not really been involved in that side. So I can't speak with much authority on the rest of Africa, I'm afraid.
Chris, quickly, somebody mentioned here that Cyprus is removing that residential benefit when buying property in their country. Maybe you can just mention to our viewers just which countries that you work with do provide residence if you buy a house there.
Currently, Cyprus still does. We've heard that might happen, but so Cyprus, yes, we do offer that. We do offer Malta. That's Cyprus and Malta are really citizenship programs that are interesting for South Africa, but they're extremely expensive. To become a citizen in Cyprus will cost you, without legal fees, everything else, 2.4 million euros. Malta, it's a 750,000 euro donation, never to be seen again, to the Maltese government. And then on top of that, you have to buy property and invest in bonds or rent property. It's hugely expensive. So we haven't done much work there, although we offer both programs. Spain, we do offer, but Spain, you cannot become a citizen of the country at any stage. You can't. So not a lot of traction, but we do offer it. Portugal is a standout one. We've spoken about that before, by a long way the most popular. We then, in the United States, we offer United States program, which is the US EB5 program. That's been strong. It's got a lot of traction in South Africa. Unfortunately, they put the entry level up from 500,000 US at the end of last year to 900,000 US. So it's a big ticket now. It's $900,000 that you have to invest as a family. You get your green card fairly soon. Your whole family can move to the States. Then after about 5 years, you get your 900,000 US back. It's basically making almost an interest-free loan to a developer on the other side. So the United States is strong for us. Grenada is another strong one. Grenada is interesting because it's a very cheap access point, $220,000, Grenadian passport within 9 months, but it gives you a backdoor access into the United States should you ever want to flip into the United States. So it's an insurance policy. A lot of people are buying there. It's a fantastic university there. Some people are sending their kids there for medical school because it's a brilliant medical school there. So those are the ones. And of course, the islands, Mauritius and Seychelles, they're residency programs. They're very popular. We continue with those. We may be bringing on Montenegro and Greece later this year or early next year. Those are the two I'm looking at the moment. But that's our sort of bouquet of offerings where it is for now.
Noni, one of my colleagues just sent me a WhatsApp and they were talking about student accommodation. I came across a lot of Section 12J funds that are building huge student accommodations in the country. Is that something that would kind of move or kind of migrate into the listed properties space? And what kind of your ideas about the growth prospects? We all know there is a huge shortage of student accommodation in the country.
So Ruan, I mean, that's not an area of focus for me. It's certainly not an expert in it. But I think student accommodation, yes, from a demand perspective, there is an opportunity there. I think the challenge that a lot of the companies or funds that have pursued student accommodation is that, again, the underlying covenant has become quite risky in that I think historically, if you are doing a student accommodation development, you have a solid underpin, whether it's the varsity giving you a 5 to 10 year lease or NAFSIS, securing the underlying rentals. I think a lot of these funds are then left with contracting with students directly. That's the first thing. So from a risk profile perspective, it then changes the nature of the investment, because you're contracting with a student versus an institution. So I think that's something that probably should come right. And I think what's happening now is that either institutions or even the likes of your lenders such as NAFSIS are giving you 2 to 3 year leases, which again, in terms of real estate investment, is not enough tenure. In saying that, there is demand. I think that the one other consideration in assessing the feasibility of student accommodation is the cyclical nature of the rental income, in essence. So you've got gap periods, I think, between probably December and February, but you've got operating costs. So it's a very tricky model to be able to get right and start delivering returns. There hasn't been any listed platforms in terms of student accommodation, and I think it is because of some of the fundamentals that are not in place. So again, a sector that I'm not really familiar with, but understand some of the dynamics that exist. And again, for me, any form of property investment is really reliant on the underlying covenant. If there's security of tenure, then it certainly makes sense for investors to come along. If there is risk in terms of that, then I would exercise a bit of caution.
We only have 4 minutes left. I can't believe it. It feels like we've just talked for 10 minutes. So we've got 2 minutes each, and I'm going to steal one from each of you because I am the star of the show. As a last point of view, Chris, what are your kind of final thoughts about your prospects and about a diversified portfolio, and just kind of your offering to any investor who is actually interested in that kind of brick and mortar, whether it's a student accommodation, a holiday flat, or just a place to retire someday?
Yeah, thanks, Ruan. Look, I mean, I think what you get with us is a couple of things. The most important one is you get familiarity. People know the brand. They've seen Pam Golding properties around. They know to go to. We live in South Africa. We're living, breathing, proud, very happy South Africans, just offering alternatives around the world. And what I do is I go to each country. We do a lot of due diligence. So I obviously travel a lot, but we do a lot of homework up front to make sure that as best we can, our investors will invest in places and in areas and in offerings that are stand up to some scrutiny. Everybody makes mistakes, and there are some that'll slip through the net. But by and large, we've done a really good job in that. And then what we do is we engage with local professionals in situ, whether that is in Cyprus, whether that's in Malta or Mauritius. We got people on the ground that we work with, from lawyers to real estate people to developers. People that I've befriended over time, that I've become comfortable to work with. So from that point of view, we're almost a little bit like a one-stop shop. You can come and chat to me and say, why should I be doing what I'm wanting to do in London and not in Birmingham? Or why should I be investing in Spain and not in Portugal? We are able to give you an unbiased view because we're represented everywhere. We don't just represent one sector of it or one specific country or one specific development. We're represented all over because I've made my business to engage with a myriad of local people, and then we've got quite a lot to offer.
Noni, you're one of the few women in the local property sector, so it's wonderful to see a strong woman taking charge of a property fund and represent. You are kind of bullish of South Africa. You're proudly here. What is your last mantra for our viewers?
So, Ruan, I think for me, what's important in some of these conversations is consider, your audience in terms of being able to provide enough knowledge and education to the man in the street that doesn't ordinarily have an opportunity to invest in property. And I think for anyone that does not operate in the sector, it is quite overwhelming to consider investing in the sector, whether it's direct or indirectly. And I think, having these type of conversations is really to empower people that, one, have limited knowledge, but also limited access to capital to undertake significant investments in property. And that's really what I represent and what our business represents. And I think to that end, the point is, we've discussed where the sector is, and I've reconfirmed just what my stance is around SA. And because we are an SA business, we've got to back ourselves, right, to be successful. I think the point about it is there's various ways in which one can invest in property, various platforms that give you access to offshore property as an alternative to directly investing in offshore markets, which is what Chris's focus is. But I think the majority of certainly your listeners and the South African community just want to understand how they put their money, no matter how little it is, into property investment, and understand those dynamics. So I think for me, it's important to have enough knowledge about the different sectors that you're going into. And certainly, I think the South African story is one that requires patience, is one that requires people, investors, to be bullish about SA. There's a lot that is uncertain. We can't ignore that. A lot of work that needs to go into the country from a macroeconomic level to get people to be comfortable to invest in real estate, which is really permanent. And really, that's where I come from in whatever conversations that we have. So hopefully, there has been some value that I've added in encouraging people to still look at SA as an investment option when it comes to real estate, and not necessarily going at it alone. There's some very credible platforms that give you benefits in terms of local and offshore exposure.
Well, one of our viewers, Sue Comfield here says, Noni for president. So you have one supporter so far.
I'm not sure if I would want to be president. I think that's a different on my side, actually.
Well, to my esteemed guest, thank you for a very, very functional, educational, and informative discussion. Hopefully, this is the first of many. I want to thank you, my producer, Nicole Williams. I want to thank you, Daily Maverick, for putting this whole show together. I want to thank you to all our viewers for logging in. I hope you found it informative as well. And lastly, and most importantly, to our sponsors, all best. Thank you very much for this Daily Maverick sponsorship. I'm Ruan from Business Maverick. We'll see you next time. Goodbye.
Thanks very much, Ruan.
Thanks, Ruan. Goodbye.